Okay, testing, 1, 2, 3, testing, 1, 2, 3, testing, 1, 2, 3. Good morning, everybody. Hello, FX Street. How are you doing?
Hey, welcome to the next episode of the Dashboard Confessionals.
Hang on, I gotta mute an ad or something. Hang on, mute. What the heck is this guy sound? Anyways, hey, good morning. It is Friday, September 7th, 2018. Welcome to Trade Non-Farm Payrolls Live number 149. Remind yourself, 120 months is 10 years. So what's 149 months? A lot. Since I've been doing this webinar with FX Street, let's see, I've made a couple of people. Right? I've moved cross country. I know a lot of water under the bridge, but like I always like to remind everyone, before Non-Farm Payrolls Live number 1, I sat down with the leadership of FX Street, and we talked about doing something extraordinary, and in particular, something that can make a difference to the audience. Something that had never been done before. And the whole idea was, hey, what if we were doing a webinar? Well, first of all, webinars didn't exist. Instead of talking in front of a PowerPoint or even just typing in a chat room, what if we showed the live market and helped people trade within that market during the crazy volatility of non-farm payrolls? Because you have to also go all the way back to 149 months ago. There wasn't a lot of resources out there to help you. That's why FX Street was born. There were no books. I went to many libraries. By the way, Amazon.com was a small, tiny company, and it only sold books. Amazon didn't have any books about Forex. So I went to the Stanford University library looking for books about foreign exchange for business students and stuff. And so there wasn't a lot of information out there. But the little bit that was, you found a lot of scumbags and scam artists that were out there hyping up non-farm payrolls, get rich quick, get into Forex, you can drive a yellow Lamborghini. It's just that easy. Look at me, I made $5,000 in 1 minute. So when I sat down with FX Street, we're like, you know what? There's a positive virtue of doing this live event during non-farm payrolls. First of all, there is crazy volatility. So if you're with me, at least I'm teaching you to harness your entrepreneurial spirit in such a way that you don't really accept or want that type of extra risk. 2, once I have you have your attention, I can teach you positive trading habits that will make you a disciplined trader that can keep you trading for many, many, many years. You'll still have blood, sweat, and tears for years, but you're not I try to get you from the get rich quick idea to making this a long-term career. Okay? And then, if you're with me, you're not with those scumbags trying to overhype you and get you to trade and all this kind of stuff. So we're like, wow, this is a really cool idea. And here we are 149 months later, and I'm still in love with Trade Non-Farm Payrolls Live with you. I look forward to it every month. And so I'd like to thank FX Street for being such wonderful, gracious hosts for, 13 years? Very, 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 very cool. So anyways, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. By the way, my name is Wayne McDonell. I am the Chief FX Market Strategist for TradersWay.com. We're a boutique foreign exchange brokerage. We have radical ideas of running a business, such as world-class customer service, very competitive fees, and for you as a trader, you would love the fact that we have very fast execution speed. For clients every single day, I offer free webinars that are about an hour, hour and a half every single day. So you put all that together. I'm here to earn your loyalty and respect. And if I've done that, please visit tradersway.com. Open up at least a demo account. Takes you just 30 seconds. You can see our back office and stuff, and maybe attend my webinars. So anyways, that's that. So we have non-farm payrolls in about an hour. There's going to be some volatility when that comes out. The idea is we will look at that as a singularity in the price time continuum. It'll move the market. It may be an important move. It may not be an important move. It may move a lot. It may not move a lot. It might go up. It might go down. So we don't know all of those things. So I'll show you how to use technical analysis for that. Even though it's non-farm payrolls, like it's an important news event, it's not fundamentals. It's just a volatility opportunity. Dane, can I get 15? Yeah, people get so angry at me for having 18 screens. People get really mad. I get all kinds of hate posts on YouTube like, what kind of idiot has 18 screens? I'm like, you don't need 18 screens. I have 18 screens. But anyways, I have 3 screens on that you can't even see in front of me. And I have a screen over there, but who cares? Don't get upset. It's so funny. I have 18. It's because I'm insecure. I'm an only child. Okay. So, but whatever. So that's going to come out. Then we have, don't forget the Canadian dollar, right? So we got CAD jobs report as well. So we got that event-driven strategy. And then an hour after that, we're going to have the stock market open and all that kind of stuff, right? And then we'll wrap up. We'll have at least an hour, probably an hour and a half of Q&A, where we turn off any PowerPoint and all that kind of stuff. We focus less on what's happening in the moment. To me, offering you the ability to plug in here and extract information that you need in regards to the foreign exchange market. Because I have been doing this for as long as there's been a retail Forex market, like 15 years or something now. Pretty amazing. So we can cover technical analysis, fundamental analysis, trader psychology. We can do things like scalping, spot trading, swing trading, carry trading, position trading, whatever. You're the boss, and I'm just a humble analyst. Huh? With a beautiful shit. So, very cool. Actually, it's very hot in here. Sorry about that. My office is soundproofed. I had all the walls and ceiling completely insulated with 2 layers of spray foam. But it does get warm if I don't have the AC running. So anyways, cool. So let's go over the credo. This is very important. I hope you don't think it's fluff, because it's probably the difference between success and failure in the long run. Capital preservation. This is the whole idea. Like, think of this credo as my number one goal. My number one goal isn't to make as much money as I possibly can today. My number one goal actually is not to lose money. And if you do the math, losing money is significantly more important than making money, because you should always put yourself in opportunities to make money. The thing is, when it doesn't work, how bad is that pain? And at the end of the day, you will be judged more about the pain than you are about the glory. And just put this in perspective: if you ever trade other people's money, they're never happy. Okay, so like if you make 3% this month, why not 5%? Oh well, they heard Bitcoin was up 10% or 20%. Why didn't you make 20%? That kind of stuff. Um, some people come to me, they're like, Wayne, I want you to manage my money. By the way, I want 100% a month. There you go. Okay. Well, no. Okay. But, right? So they're never going to be happy because you made the money, but why not more money, right? But, what if you lose money? 10 million thousand times worse, right? So your goal, if you're a conservative, disciplined trader, should always be worried about, let's say not worried about, you should be focused on your capital preservation, never putting yourself into a situation that isn't planned. I mean, put it this way, you should have an unfair advantage. When you trade, because you've done so much thought into your trade plan, you should be shocked that you didn't make money. I think if you've lost money, like if you've gone through a bad period where a stretch of some trades that have lost money, what you'll find is, I bet you anything you haven't actually planned a trade. When you go through a bad period, very often you're reactionary. You're not planning things in advance. You're not waiting for true support and resistance. And you know that, right? So to put it in more of a positive way, if you're focused on trade planning and you're focused on only entering trades that you've planned, for example, you only buy at support, sell at resistance, right? It's the positive way of saying you're doing all of this, not because you want to make a ton of money, but you're putting all the time and effort and resources into your trades because you don't want to put yourself in a situation where you're going to lose, because losing is actually at least twice as bad as winning. Let me give you one more example and then we'll move on. If you lose 50% of your account, you have to make 100% return just to get back to break even. So you lost 50%, now you need to make 100 to get back to zero. So with that argument, I say it's twice as bad to lose, right, than to win. So start everything with that. That's why you plan in advance, right? If you, in my book, which I wrote 10, 11 years ago, I believe I opened with the art of war, right? An honorable general wins because many plans were made, right? That's the whole idea. Honorable because you didn't have to kill half of your troops to win the battle, right? You win easily because you outsmarted the other general and the other armies, and because you had an unfair advantage, right? Because they walked into your traps, for example. Now, I think of trading like that. When I try to teach you to plan your trades in advance, and if you do that, then most of the time, trading is actually quite boring because you're sitting around waiting, right? The exciting stuff, like, hey, you can drive a yellow Lamborghini, watch me trade, boom, 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 boom. I just made 5 trades, woo, 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 woo. Like that stuff isn't actually how you trade. Most of it should be, fundamental analysis, long-term technical analysis, looking at correlations, looking at multiple time frames, drilling down, and identifying the next 2 levels of support which you might want to buy, or maybe the 2 levels of resistance in which you may want to sell, and then you have to wait. It's not boom, 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 trade, 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 trade. Right? Marcus says, I'm quite boring. Well, thank you, Marcus. I really appreciate that. By the way, you misspelled your. But anyways, let's move on. Now, once you've planned your trades, right, this whole idea of every trade you should have a minimal acceptable performance. And that's not a target. It's worst case scenario, right? What should this trade pay you, even when it doesn't fully go to fruition? So, for example, I analyzed my trading, and based on my results at the time, my minimal acceptable performance for every trade was 15 pips, right? Which means if I wasn't, I should be shocked that I didn't make 15 pips on a trade. Which means if I'm shocked, then I must be going for 30 or 40 or 50 pips on the trade. Well, going for, what does that mean? Well, in the previous part, capital preservation, I've analyzed market conditions. I've used technical analysis to set things up. Actually, Marcus, I am retired. You're so funny. You're so funny. I've been in grad school, Marcus, for almost 4 years. Yeah, but anyways, Marcus, you're right. I'm an idiot. Don't worry about me, Marcus. All right. So, anyways, when you do your trade plan, you do your analysis, you can look at this and then say, all right, this trade plan, let's say a Fibonacci retracement predicts potential extension, right? You look at that and you say that should yield, let's say, 50 pips. It could be 100, but whatever it is, you've done a plan. You're like, okay, I like this pullback. I think it'll do this extension that yields a certain amount of pips. So you should enter it with the idea that you're going to get that 50 or 60 or 70 pips. And you should, if the plan was valid, it should be good enough of a plan that at least it starts in that direction, right? I mean, a trade that never starts is a pretty bad trade. And then you can move your stop closer as it starts moving toward the end goal, right? And then, even if it collapses, that trade, I bet you, should offer you at least your minimal acceptable performance. The idea is that these little wins actually are what pay your bills, right? Right? That's what pays your bills. Because your big winners are, let's say, unique events. And for, your losses, let's say you should never have big losses. So if you don't have big losses, well, you're still going to have losses. And let's say you have a reasonable amount of smaller losses, but they all kind of add up. So your big, unusually big wins should pay for all your losses. And what you're left with is your average, boring, kind of disappointing trades, right? The mediocrity is what pays, right? Moses, why don't you go to tradersway.com and ask support? Okay. Now, let me also be clear. So the first two keep you from big losses, right? We all know that you want to keep your losses small. That's what capital preservation and capital acquisition does. Even you get your little winners, and you manage your risk properly so that first you never get yourself into bad situations because you've planned, and then B, you're managing your stop and giving yourself an opportunity to make either remove risk or make a small profit, right? But once you've done that, the third part, right? The third part means now that you've moved your stop to map, now you go for the big pips. You go for the big trade. You let your winners run. That is important because, like I said, in the beginning, it'll at least pay for all your little losses, and you'll live off your map. But over time, what will happen is your minimal acceptable performance will happen more often than not because you're a good seasoned trader. You're taking good trades. You're waiting for good setups. You have a lot of experience under your belt, so your trading gets better. Your percentages and all that get better. So what will happen over the course of time is your maps now, your little winners will be significantly more common than your little losers. So now your map pays for your losses, and all you have left are these more common but bigger wins, right? So in the beginning, you might be happy with like 200 pips profit for the month, but down the road, let's say 10 years down the road, you're looking more like 2,000 pips is a decent month, right? What about 10,000 pips? And people are often shocked. They're like, what are you talking about, 10,000 pips for the year? I'm like, no, 10,000 pips for the month. Like 10,000 pips for the month? Oh my God, I never even thought that was possible. Well, it's because you don't let your winners run. And you won't know until someone shows you, and I guess that's why I'm here, right? But to get to that point, to be strong enough to let your winners run, and to be disciplined enough to manage your risk properly, or even just to look for proper setups, it all happens in stride, if you will, right? Right? So that when yen pairs take off, let's say in September, you're able to keep those winners all through September, all through October, all through November, and all through December. And you're like, wait, I've never held a trade for 4 days, yet alone 4 months. Like, yeah, well, we need to get you there. Anton says, my maps often kill potential bigger targets. Yeah, okay. So now this is what you should do, Anton. You should focus on, and by focus I mean you should practice and track the results of your practicing on moving. When do you move your stop to lock in that map? And sometimes it comes down to like what type of trade setup you have. Is it swing? Or is it a shorter time frame? Right? That'll adjust. But for example, maybe on a demo account, every time you want to trade, right? Or how about this on your live account and then open a demo account for practice? Every time you trade, right? That means on your live account, because you're already trading, pull the trigger, manage it the way you have been. Okay? You know what I mean? And then on your demo account, manage it differently to try to get better results. So for example, you might try something like don't move your stop as quickly as you normally do and see what results that yields. And if you do better than on your demo account than your live account, what you've learned is you're moving your stop too quickly, and now you can focus on adjusting your risk management, right? If, however, you on your demo account, you don't move your stop so quickly, and the trade collapses, and all of a sudden on your demo account you have losses, but on your live account you have break evens. What you've now learned is your trade planning is the flaw, not your risk management. Because the fact that you move your stop and get knocked out of break even, that actually might be the best thing you're doing. You're recognizing that your trade has fallen apart, so you move your stop to break even, and then you get knocked out. And you're like, oh man, I always get knocked out. Well, let's measure that and get the real statistics, and you will learn from that. So again, if you do better by not moving your stop so quickly, now you've gained some knowledge. Your risk management is now improving, and you're getting paid better, right? Because you're not moving it so quickly. You're not so scared about the small loss. But if you end up with losses on that demo account, it means your trade plan was flawed anyways. Okay? Okay, this is my chart setup, so if you're new, please take a screenshot. I'll give this a few seconds and then we'll move on. Okay, as far as techniques, I mean, this is the setup, and I use this to as analysis, not necessarily for trading. There's a difference, right? For analyzing market conditions and stuff. The primary tools that I like for actually trading is pivot points and price action. Okay, I could delete all of this and still trade profitably as long as I had pivot points, which is just a leading indicator, and then price action, which is it's not a leading indicator, but it's a leading methodology because I'm using price to identify things like support and resistance. Okay, right on, Anton. Cool. All right. So what I want to cover today is just the basic setup. I've been doing this for 13 years on FX Street, so I'm going to assume a lot of you guys know this, so I'll go quickly. But this is the 21 and 55 EMAs, and I use these two EMAs to measure market conditions, and by market conditions I mean market. Okay, I mean the market. What is the market? Well, let's define that. I used to have people come up to me and say, "Hey, Wayne, so how were the markets today?" Well, I used to think about it. I'm like, well, that's hard to answer because it was up for a while, then down for a while, then up and then down and then down and then up and then it spiked and then it dropped back. And then if I said that to someone, they would look at me like I'm crazy. So I said, well, I need to identify what the market is. And the market is sort of the overall picture. So in this case, the 2155 tells me that the market is bearish. Technically speaking, it's bearish. 21's below the 55. Got it? Great. Now this was important to me because it told me in a bearish market, I'm better off selling. So I could look at this and say, I'm only looking for selling opportunities. Okay? But it doesn't help you pull the trigger. So you can use I have here the 5 and the 8, the 5 EMA, the 8 SMA. And this combination tells me when to sell and when to take profit. So for example, if I started the day, you can see the previous period or the previous day on this USD Swiss franc was bearish, right? It was bearish yesterday, so it's bearish again today. I would have already have been bearish. So at the beginning of the period, I get a 5A cross down, but I'm already bearish. Technically, the market is bearish, so I'm already looking to sell. So I get this 5A cross, and this gives me the permission now to sell in here. Okay? You can see I got like 4 hours to set this up. Okay? And then, of course, it fell. The 200 EMA, I consider the fair market value, or long-term trend, if you will. Bollinger Bands, they offer a measure of volatility. When they're wide, lots of people are trading. When they're narrow, nobody's trading. So these are not good conditions for trading, and that's what Bollinger Bands tell you. Another way of looking at Bollinger Bands is instead of volatility, if that messes with your mind a little bit, consider it volume. Right? Lots of people trading, hardly anyone trading. That's another way of looking at it, but it is vol, not vol. Okay, so that's what a chart looks like. Now the thing is, I look at multiple charts. This is just one time frame. So this is an hour. Often I look at a 4 hour, a 1 hour, a 15 minute, and a 5 minute together. Sometimes I look at the 1 minute. Sometimes I look at the daily as well. Okay, we call that fractal geometry. On the lower part here, you can see I have two oscillators. So remember, the moving averages, the 2155 combination, helps me discern market conditions, right? Or overbought and oversold condition. Well, I shouldn't say it that way. Market conditions for the market, the speed of the market, for example. The 5/8 helps me measure price action, market conditions, price action, market conditions, price action. They're two different things. What I'm trying to do is say the market's bearish, but sometimes when the market's bearish, price is moving up. Okay? Not good. But when price starts to fall again in a falling market, that's the best opportunity to sell. So that's what I'm trying to do. Line up market forces with price action. Now, when I look at MACD now, not the moving averages, I look at MACD, I slow the MACD down to give me overbought and oversold conditions, because that's what an oscillator does, overbought, oversold, overbought, oversold. I'm using MACD slowed down to measure overbought and oversold conditions for the market. Then I take a stochastics and I speed that up, and I use the stochastics to measure overbought and oversold conditions for price. Once again, separating market forces from price action. And I'll do that on multiple time frames. Okay, so we can go over that later in the course, and that's the complete chart. Okay, so after the news and all that kind of stuff, if you have questions about it, we can go through that again, and I can show you in the live market more current examples of that. And then also how I fold in other things, like I said, price action, trading as a methodology, and pivot points as a leading indicator. But if you can't figure out whether the market's rising or falling, all that other stuff is irrelevant. Okay, so we'll do the new scalp stuff a little bit later. I want to go through FX Street for a little bit. There we go. I think you guys can see that okay. Consensus this month is 191. Previous was way off from that. Now, I think these are seasonally adjusted, right? Because I always think of like, well, in August, do people actually hire? But I'm sure they're seasonally adjusted. But anyways, it's amazing how analysts say, well, last time it was 157, but this time it's going to be 191. Well, there's a lot of parts that go into this. Okay. And the parts are now published down here. Okay. NFP wasn't that great last month. Challenger, they laid off 38,000 jobs this month, which is not that good. So usually what I'll do is at the very least, I will take 191, subtract off the 38. So that's basically, it's going to be about 157 again, right? So I just dumped it down in my mind. I'm like, just over 150. Yeah, so it should be, my random guess here so far is it'll be about 150, 160,000. Okay. Initial jobless claims. Now, here's something interesting. Okay, it was less than, so this was yesterday. Came out good, right? 213,000 versus 214,000. FX Street, you might want to add to this. That was the best number since 1969. What? That's the best number, 213,000. The best number. Right? John, you're a client. I can answer that all day, every day, in our daily webinars. But yeah, sure. But anyways, the best, isn't that amazing? The best number since 1969? Incredible. So that might point to a really good NFP. Okay? So now I might take my 150 kind of idea and then say, well, I'm going to add to that. So 165. 165 would be the number. Okay, so now, right? ISM, good, good. This stuff I don't care about. ADP. Okay. Just happens to come out the same number I just said. And jolts. So some of this stuff I don't use for NFP. All right, well, very nice. Very nice. So I don't think we'll beat the 190. I don't think it'll be bad. I don't think it'll be a game changer. Right? I don't think it'll be a game changer. The Fed's going to do what the Fed's going to do. So there shouldn't be a radical response to non-farm payrolls unless it's a significant difference. And it shouldn't be a significant difference. But even then, like the spread from last month 157 to this month 191, that's quite a spread. 40,000 jobs is quite a spread. So the real surprise would have to be like 240 or something, which would be very, very, very unlikely. We should probably look for a revision. So what if we came out like this, like it came out about 191, but this 157 was revised up to like 180. Yes, Lucky, I just didn't want to do it too early. Oh, John, yeah, I'm not sure what part was different, but yeah, let me know on Monday. We can do that. Can we look for front run swing positions at no? Joe, did you not watch the video from the swing trading group? I did it yesterday. I sent out invitations and everything. But anyways, it's on the site. So what else is going on? Unemployment rate, fine. Labor participation rate, fine. Average hourly earnings is the big one, but again, these things don't move very often. So I think the best thing we can hope for is going to be 157 being revised up significantly. So a good number on NFP on the headline and a big revision. That would be interesting. That'd probably be the most likely scenario in which the market will move. Okay. Oh, good, Joe. So then I wouldn't want to cover that in a general community, right? And that wouldn't be a Gen Pop type thing. People wouldn't have been trained properly. So, all right. Patrick says, so we should buy the euro dollar. Well, let me comment on that first. Not necessarily. So, yes, I would typically argue, over the last, let's say, 13 years I've been doing this webinar. Generally speaking, I would say that. I would say that's good for macroeconomics. The United States is doing really well. We're going to import stuff like crazy because we're filthy, stinking rich. We expect to be filthy, stinking rich. All that kind of stuff, right? Right? I busted out the formulas at Harvard and all that kind of stuff, so I can prove it. But let's just say, yes, typically that's good. So you would want to buy euro, sell the dollar. Okay. However, we're still not in proper free market conditions. Many central banks are still manipulating their money supply. We don't have completely solid macroeconomics yet. The US dollar, typically, if everything was right as rain, would be weak in the scenario of a very, very strong US economy. But the problem is globally now. For example, Europeans are so poor, they don't import anything. It's amazing. Look at the import-export data out of the Eurozone. They don't import. Why? They don't have any money. It's crazy. So that affects China, right? China would love to export stuff to the 600 million people in the Eurozone, but it just ain't happening. Right? And so therefore what's happening is the Fed has to raise interest rates, but in these market conditions, relative to others, there's a global drag, which means, people would rather put their money in the U.S., in a U.S. bank than in a Turkish bank, right? So every Turkish billionaire has moved all their money out of Turkey and moved it to the United States. Every South African billionaire has moved it out of South Africa and put it in a bank in the United States. Every billionaire in Argentina has moved their money out, right? And moved it to the United States, right? Because it's safe, but also now the United States is a high yielder, right? And which eventually is going to be consequential because now then it makes U.S. products and services more expensive and all that kind of stuff. But also the big problem these days is that these emerging markets have borrowed debt in euros and dollars, and their currencies are falling, which makes those debts more expensive. But in a case like Turkey, Turkey doesn't export anything, right? Europe's not importing. Turkey is not exporting. Turkey has loans in euros and dollars, lots and lots of loans. There's shopping malls in Ankara with debt, and they have to pay that debt in euros and dollars. Well, here's the problem. Because they don't export, they physically don't have the dollars and the euros, right? So now what? What does Turkey have to do? Go to the foreign exchange market, take their lira, which doesn't buy it a lot, so now their debt costs more, and then they go to the interbanking system to buy euros and buy dollars to pay those loans. But when $70 billion of loans come up, those borrowers now have to go to the interbanking system, right, our intermarket system, the foreign exchange market, and convert their lira, 70 billion US dollars worth of lira is coming up. So imagine how many lira you need for that, 100 trillion lira, now has to enter the market to buy the 70 billion worth of US dollars. That drives up demand for dollars, but what does it do to the lira? It increases supply globally of lira, and the lira gets even weaker. So then they have to exchange more to pay for their next debt, which weakens it further, and then more, and then further. And it gets worse and worse. Oy vey. So we're in a world now where there are several countries, and I imagine all emerging markets with foreign debt, are facing this, and it's because the dollar is going up. And well, if Europe could just fix itself and import more from China, they will weaken the value of the euro, and the dollar will do the same. So the dollar and the euro will weaken, which means emerging markets can afford their debt a little bit more. But then Europeans and Americans will buy more stuff from these foreign countries because their currencies are cheaper, therefore their workers are cheaper, which means those markets will get access to foreign exchange, plus they'll have jobs, and plus now they'll start exporting because the developed world will be importing, and we'll be right as rain again, and then we'll have a good non-farm payrolls report, and I'll say, look, dollar will weaken because everybody's rich. But the problem is Americans don't make the dollar strong. Americans make the dollar weak when they buy foreign products. So it's foreigners making the U.S. dollar strong, and that's hurting foreign markets. So really, and I said this in probably 2009, I said, China shouldn't spend $1 trillion stimulating their own economy, which they did. They should spend $1 trillion on Europe and save the European economy. But we got this whole Eurozone thing where the Dutch lend money to Germany and Germany gives the money to Greece. All that kind of stuff. It's a real problem where Greece should have the ability to devalue their currency, but they can't. Luis says, I got that from your book, Wayne, but when does the cycle stop, though? Well, there was a Nobel Prize winning economist. I forget his name. I believe he was the first African American to win a Nobel Prize, or at least a Nobel Prize for economics. Richardson, is it? Anyways, he talked about virtuous cycles, right? That are good, but then there are cycles, and what is it? Vicious. The vicious cycle is what like a country like Turkey's in, where it gets worse and worse and worse, and it snowballs faster and faster and faster. Right? So when does it end? Well, right now, the only thing Turkey's doing, as far as I know of the Turkish economy, to get foreign exchange is tourism. Right? So some people, go to Turkey and buy a Rolex because the foreign exchange rate is so favorable, and locals haven't changed their prices yet because they haven't had to go to Switzerland to buy new Rolex watches to replace their inventory. So if you're quick enough to get a Rolex watch out of Turkey, you can benefit from the foreign exchange, just like London did, right? Remember Brexit? Yeah. So foreign exchange is really good. You can get those deals, right? And benefit from the positive foreign exchange as a foreigner. But that window shuts when new inventory has to be bought at the weak local currency and so on and so forth. But anyways, how do you fix Turkey's situation? Make something and sell it to foreigners. Okay? Participate in the global market, the global capital market. That would be a good way for Turkey to improve. Anyways, let's get going. Right? You want to get rich? Global trade would be good. Open markets would be good. Okay? All right. So anyways, Non-Farm Payrolls is going to come out. I try not to pre-guess what direction it's going to be because really it could be any guess. And even if the number is good, doesn't mean the dollar has to get strong. It could go weak, and then we'll say, oh, well, that's what it's supposed to do in global macroeconomics. But the number could come out good, and the dollar could get strong because we'll say, oh, well, that will force the Fed to raise interest rate further. And, it's going to do whatever it wants to do. Okay? So just let it do that because this is not long-term fundamentals. This is just volatility. Traders could have trades above it and below it, and some traders might be hedging and others may not. Like, you don't know other people's portfolios. So don't get caught up on guessing or this means this and that means that. Be Buddhist or Taoist or whatever and just say it just is. Okay? And then we can deal with fundamentals later. So anyways, the news comes out. Oh, look, euro dollar comes down. That's all we care about when the news comes out. And if we get a big red candle like in this example, okay, then it tells us a lot. So in this case, this was, I'm getting a beep. Oh, was that FX Street's thing? FX Street beeps, huh? All right, I'm going to kill FX Street. Sorry, FX Street. Okay, so in this case, news comes out, green, 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 green. This will be a 1 minute. You can also do this on a 5 minute if you prefer. Okay, green, 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 green. If we see green, 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 green when the news is released, I'd suggest we should consider that a bullish move. Okay. Therefore, we want to look for a pullback, and this is what this is all about here. If we want to buy a dip. We want to buy a retracement. We want to buy a pullback. That's all it means. So we need to measure that, and I typically use here. I typically use a Fibonacci retracement. So I'll try to draw that. We should have enough time for that. I'll try to draw that. Also want to look left and that kind of stuff and say, use this old resistance as support, as a role reversal. Okay. This is an example. It went further than I would have liked or hoped, but I'm not trying to give you a perfect example. I'm trying to give you a realistic example. And, these markets move fast, right? So in 2 minutes, it's made a 786 retracement. But the 3rd minute held, the 4th minute held, the 5th minute held. Okay. So somewhere in here, you have to make a decision to buy. And here's the cool thing. Your stop just goes below here. So your stop's only 25 pips away. Super, super easy. Now remember, it's a scalp. It's a scalp. There's not enough time for a group hug or a committee meeting or anything like that. You're not allowed to lose a lot of money. It's just a scalp. It's barely even a real trade. It's just a scalp. It's just a high vol trade. Okay? So don't risk more than 25 pips. Okay? So you decide after 2 or 3 minutes of 786 holding that you're going to buy it. You drop your stop just below here, and then you're done. Now, if you can, and usually you can do this in 2 or 3 minutes after you enter your trade, move your stop to break even, because the hero or zero moment is when you approach the line in the sand that held us back in the first place. The price that created the retracement. There's something going on there. Either bulls are getting out, in this case near 149, or bears are set up to sell near 149. Okay? But we know something's likely to happen around 149. If there are lots of sell orders here, 149 is going to hold, and this is going to collapse, and you're going to get knocked out at break even and not lose any money. Huh, cool. Now, if there are buy orders just above 149, then when it goes up there, it's going to hit buy orders, and it's going to take off, hit any sell orders that bears had, and then it's going to take off even further, and you get paid. So with a scalp, ideally, when you get to this line in the sand, your stop should be at break even, and you're at hero or zero. Okay? And then this is the moment of truth. If there are sell orders, it's going to collapse. If there are buy orders, it's going to take off, and you got paid. Okay? Bradley says, I place stops 25 pips below the 786 to invalidate the setup aggregate to... Yeah, I'm not entirely sure what you're saying there, but are you saying that you sell off of a breach of the 786? Or, yeah, I'm not sure what you're saying there. But anyways, there's a bit of a lag, so we'll just move on. .com. So I'll kill that. There's the market. I got a lot of trade plans already drawn up, but we can cover those later. Okay, that was the general feeling a day or two ago. You can see I have resistance identified up here, a possible swing trade up here with this bottom holding. Okay, this in here is a moderate level of resistance in which I believe bears are going to live. So I'm going to drop into the 15-minute chart here and take a closer look. And yeah, this gray area, very, very, very important. For this trade to hold, this longer big swing you can see to the right, this was set up with a double bottom on support that we predicted 2 weeks ago. In a counter trend trade scenario for the bearish move, this green area was the target basically, or this orange line was the target for our entire week this week. This week's projected low was right where we hit. So a double bottom forming there potentially can be bullish in this downtrend because we have monthly support and weekly support. Then the higher high, oh my right? So then, I guess it was yesterday or the day before, we set this up to be a double bottom 1, 2, 3 with a 4 projection above us. And, well, right, the support is held, but it hasn't produced the rally, and that's probably because of non-farm payrolls, right? So now that we're stuck in the middle here, I don't think I'm going to delete the analysis. I think they're still going to be interesting. But I think if this drops like a ton of bricks, we might look for a bounce here. I'd rather this break to the upside because it's already part of the next plan. But this and this are sell zones. So I want to add a layer to this. This area here, okay, I think there are going to be bears. So I'm going to move this sucker. I think there's going to be bears up there. So let me move this around. Okay. So I think there's going to be bears at, what is that, 116.50? Am I reading that right? 116.70. 116.70. And the next one's going to be closer to 117.50. So basically 1650s, 1750. Okay. So we'll go back to FX straight. We'll pull up the calendar so we can get the number. Loading, loading, loading. Keep the calendar loading. Okay. Oh, and don't forget CAD. Don't forget CAD. CAD's also going to move here. So, once again, thank you for the loyalty and your respect you show me for all these webinars now. This is the 149th month I've done Trade Non-Farm Payrolls live. Thank you very much. If you would, please visit tradersway.com, open up a demo account. Okay, we should have news coming here. Numbers are populating. 201. Oh, a revision down. Is that right? Last month it was revised lower. Oy vey. So be careful on this one. I think what's going to happen, because we beat the headline, I think because we beat the headline, you're going to get a snapback. So let's drill in here. So at first it's good because it's more than 200. But then last month was revised from 157 to 147. So people are going to say, oh, snap. But remember, they didn't see it at first. So got to be a little bit careful on this one. I think we're going to be vulnerable to a snap or reversal once people figure that out. Rolling, rolling, rolling. So there was another miss here on the unemployment rate went up 3.9. And that means more people are entering the labor force, which is actually an economically good thing, right? Because basically everyone that wanted a job had a job, but then wages started going up just enough that people that haven't been working, that haven't even been looking for a job, suddenly are getting job offers that are probably too good. And they're like, oh, well, I guess I'd turn off my PlayStation and take that job if it's going to pay me so well, right? So the only way, you can hire 200,000 more people and have unemployment rate go up, right, is if the labor force participation rate is moving in a positive way. Okay? So that is very interesting. Okay? Canada, wow, their jobs report sucked. Come on, CAD. Wow, so CAD's being punished anyway, so that's insult to injury. So I'm going to look at that just quickly here. So I think this is already part of my plan. Look at this. Pachow. You see the plan? Let me go to a 4-hour. Check that out. Oh, now I'm too far. Oh, check this out. So the plan was for it to come down here and then rally up. And it's done just that. This is the down and up move. Cool. Bounce, bounce, bounce. Pachow. Cool, man. That's perfect. You're going to have to wait on the 5-minute, I think, for these retracements. Pachow. Okay. You're in the red zone here is an area of caution. So I would expect this to come down now. But let me go to 0. Now, it's interesting, right, that there are people that track, let's say, the Canadian report, Canadian employment report. They track it all day, every day. They have all access to the numbers, access to the research, primary and secondary research. They're interviewing people, right? And they say, based on our analysis, we think Canada will add 50,000 jobs. And then it comes out, no, it lost 50,000 jobs. Like if you were 100% wrong, there would be no jobs. So it's like 200% off. If that's logical, right? Instead of plus 50, it was minus 50. That's a heck of a spread. Right? You're not off 50, you're off 100. Okay, I don't see any major important reason for this bounce, so this is good. Okay, just to remind you, this area here is considered the sweet spot. If you're going to look for the high volatility event-driven strategy that I outlined earlier. Yeah, Luis says you've already been short CAD this week because of the plan. Yeah, and that's what I already highlighted, right? That was our plan 2 days ago. So now it's working out. Right? Yeah, well. All right, so this guy's playing hard to get. This is starting to look like it's not even going to pull back to a 3A2. That's your call if you're going to be that aggressive to sell off of a 5. Okay, I guess a moment like NFB would justify that. But my rules of engagement is at the bare minimum, I would want a retracement to a 382, right? Like that. That'd be the bare minimum. I would prefer a 618 on here, at least a 50%. But that's what I would prefer. So to this kickoff here, if you want that, that's yours. That doesn't fit my rules of engagement. Okay. Let's go back to Kitty Cat. Let's see if that held. Still holding. Okay. Okay. There's a lot of resistance here, so I would still expect, even if you're a bull, you would expect and even hope for a pullback. This one I'm going to make a 382 because of this roll reversal. So you do it like this. Okay. Hey, by the way, would you please do a thumbs up? I'd appreciate that. Just click the whole thumb thing. I'd appreciate that. And I said, as I said earlier, if you'd please consider visiting tradersway.com and opening up a demo account, give us an opportunity to show you what we can do, maybe earn your business. Just try a demo. Give us a shot. I do free hour-and-a-half webinars for our clients every single day. A button is in your back office to join those webinars. So at least for that, maybe visit Traders Way, open a demo account, and then on Monday, attend my webinar. I'm doing my webinar live from Napa Valley on Monday. Okay, here it comes. Right? Now, if you're a cheeky monkey and you're already a bear, this is your opportunity to sell. It's dangerous. Your stop should be close. It's not something I like to do, but if you were bearish anyways, this would probably be an area you would consider. I mean, this is just price action wise resistance, right? But this whole pink zone is the projected top for the week. So you were supposed to actually take profit on Tuesday and walk away. Okay. So if you think the dollar's now going to weaken because people realize last month has been revised down and the euro dollar is going to flip, then this is the flip for you on USD CAD. Now, I'll preface one more thing. The CAD news sucked. Was terrible. So maybe buying CAD, even though you got a technical setup, maybe it's not the greatest idea in the whole world. If you thought the US dollar was going to weaken, maybe you can find something to strengthen a little bit better than that. Okay? There might be something better is what I'm trying to tell you. Just because it's there technically doesn't mean it's the best thing you should be doing. Okay, so we didn't quite even get a 382 on this. Boo-hoo. What I would do in this situation if I were me is I would look at this now on a 5-minute chart and just assume it's still going to do the pullback. Okay? Right? It's just not quite as much of a scalp. It's almost more of a spot trade. And I would treat it more, not even, like I said, not even really like a scalp. I would just do some price action spot trading on this. Okay? Which still means sells. It's the same thing. It's just not the volatility, right? Okay? So there's the setup in here. You went long? What are you talking about? Off of what? Oh, you fibbed this? Oh. Oh, I wouldn't have done that. Yeah, once we breach this, right? Anyways, I don't mind you longing, but I don't understand the fib part. Okay. All right, so now I got to make a decision. You guys want to sell here or not? This is not working. Is it not working? I killed my EA. After he loaded. It seemed to have killed my EA. Huh. Killed my EA. Anyways, I wanted to sell here. So remember, after 2 or 3 minutes, you should be able to move your stop to break even. No, I'm not going to do Turkish lira today because it's not a conservative trade. Okay? It's not a conservative trade, and I'm not here to get people to overtrade. So we're moving along, doing its thing. Okay? Now can I get a thumbs up? Please? So it's doing its thing. What time is it? 8:45. Yeah, we got time for this to roll, and then of course it's going to consolidate before the stock market open at 9:30. Okay. Let's take a look around the world. we'll look at everything, and then we'll do some yen pairs, right? Let's do gold and oil and all that kind of stuff. Okay, we're back to old support now. Before non-farm payrolls, cancel. Before non-farm payrolls, my trade plan was to have it up, down, and then up. You can see it went straight up, hit my target, and then retraced. All right, well, sorry. But I still wanted it to hold above this support area. But you can see with the volatility, it's come down to the old support. Okay. So as a bull, it's an opportunity to try again. So if I was a bull on gold and I was creating trade plans for today, I would say, all right, my first opportunity to buy is going to be off of this area. Okay, that's the first opportunity to consider. Okay, the second opportunity to consider would be to buy here. Now notice that's called trade planning. This is what I mean, like if your trading isn't boring, you're doing something wrong. If you're sweating bullets, it's because you're doing something wrong. Okay, so in this case, you start the day and you're like, oh, I'm bullish. If price falls, I'll have opportunities to buy because I buy low, I buy at support. Okay, great. What are the next two levels of support in which I can consider buying? This one's an obvious one, and the next one's an obvious one. So that's where you set your traps. So you can buy it here, drop a stop just lower than that. You're done with it. Okay? If it breaches and you lose a little bit of money, okay, well, either it swings down, swings up, and then swings down and swings up, and you buy it on Monday, or you let it drop to the next level of support and you try again. Little shots, though, right? So remember the idea that you keep your losers small, but let your winners run? Yeah, you take a little shot at it here. If you lose a little bit of money, no big deal. And then you try down here, and if you can buy that, right, try again. If you lose a little bit of money, it's no big deal. But you're trading in the direction of your bias and ideally the prevailing trend. The issue on this time frame is there's no prevailing trend. On this time frame, the prevailing trend is down. So what if you were a bear? Well, first of all, you have the scalp, okay? But if you're a bear and you want to sell the next opportunity, it's probably the same plan out of non-farm payrolls, right? So you look at this, also look at the old role reversals. So if I were advising you and you told me you wanted to sell today, like, Wayne, I just got to get short gold today, I just gotta, then I would say that is your sell zone in here. Okay? That's the sweet spot. Up, 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 right? Right, I guess in this case, up, up, right? Down, 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 up, up, sell, down, 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 down. And then, of course, your down, 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 down is only going to get you to the next buy zone. Because all buy zones are born on targets. A bullish buy zone is a bearish target, or should be a bearish target. Because for the first move up is not going to be bulls buying. The first move up is going to be bears taking profit. If you don't have bears taking profit, then all you're doing is consolidating the market. You're trying to hold up a waterfall with your bare hands. Okay? It helps if someone turns off the water. Okay? And that's the analogy here. If bears, let's say it does fall here, and bears take profit, it's like turning off the water. It's going to make a bullish climb significantly easier if you don't have water falling on your head. Okay? So the whole every bullish move is born with a bearish exit first, and then if you can convince other bulls to buy, then you get a change in trend. Cayman says it pays to trade with you, Mr. McDonell. Thank you, Cayman. I salute you. Ho just gave me a thumbs up. Thank you, Ho. Muchas gracias. Muy bien. Very, very, very cool. Okay. By the way, so if you do have questions, let me know. There is about a 2-minute delay, so reference what you're asking me about. So I'm going to move away from gold, but don't say something like, what if you want to sell? Because now I might be talking about pound dollar, but by the time you write it, you're still talking gold. So make sure you preference or reference what your question is about, but please ask questions. I'm super happy to answer questions. In fact, I already know what I want to do in all these markets. I already understand technical and fundamental analysis. I already have my own bias. I've already done the fundamentals, so I get it. I know it. So I'm here for you, and I'm happy to share. It's the raison d'être. See ya, Avi. Sharp, sharp. Cool. So I'm going to move on from Goldie to Oily. Okay. What was my plan for the month? Let's see if we can figure this out. Okay. We had to sell here and we had to sell there. Here sell, there sell, everywhere sell, right? This is an old trade plan that failed because back then we had two plans. Just like I showed you on gold, I said, all right, if you're a buyer of oil, you'd want oil to go up either here or you'd want oil to go up here. So it fell through the first one, hit the second one, and then it's been up ever since. But notice it goes up to the weekly target and then down. Okay? This is important. First of all, bulls would have taken profit here, just like I showed you. Every bearish move is born with a bullish target. Okay? But check this out. If bulls exited here on a weekly basis, like they were supposed to, this is also a monthly short. So this arrow down here says we can potentially fall all the way back down to $64 a barrel. Oh, what? From 70 to 64? On one contract, it's $6,000, right? That potential is there. If you are a bull, however, let me readjust my old entry plan. This is from that old entry. This is very, 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 very significant to a bull. It almost has to go up if you're a bull here in this price area. Okay? So let me drop into like a 1 hour or something. Specifically, you want this price, right? And you want this price. So put it together. That's your sweet spot. And by the way, we talked about this like 3 days ago, 4 days ago, 5 days ago. None of this is new to Traders Way clients that go through our webinars. This is just our analysis. The green area is a pivot point, which suggests that's where weekly bears should take profit. Weekly bears should take profit. Okay, that's what this, this doji candle. And so what do you call this? A morning star? That's a reversal pattern, right? But at the exact spot that you would want. Again, the green candle is not bulls, it's bears taking profit. And then to add to that, you see this, I call this an Arctic turtle. I don't need to explain that right now. But anyways, we stretched out of the weekly target to hit the monthly target. This area here is a monthly pivot. So bulls really, really, really want this zone here to hold, to act as support. Another way of saying it is nobody minds a double bottom here, but you can't make a lower low. If you want this to be bullish next week and the rest of September, this is your line in the sand, okay? That's the one that you fight for. That's your Alamo. There is no fallback position. There is no retreat. Oh, Kevin asked, you mentioned a swing video. Is that available to the general public? No. Only to traders' way clients? No. That's actually part of my swing trading group. We meet once a week to set up 100 trades that should yield at least 100 pips. And then we meet once a month to set up trades that should yield at least 300 pips. But everyone in that group has gone through a swing trading course, which is like, 24 hours worth of videos at fxbootcamp.com. And then after people graduated, they're like, hey, I want to do this with you live. And so by demand, I created that group. So that's what we do. 100 pip trades and 300 pip trade setups. So no, it's not only to trained professionals. Okay. So even though there's no Alamo, there's always another Alamo, right? It's sort of like trading's like, you cut the head off the Hydra and there's two more heads, right? But so that's that. If you want this to go up for the month of September, you kind of have to do it now. No joke. This is a buy zone. That's not 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 a buy zone. Like it needs to go up if you're a bull. If you're a bear, you already sold. I mean, that was so last week that we set up the sell. But anyways, actually we set it up way down here. But if you're a bull and this does fail, then your next opportunity is way down here at 64, which I've already covered, right? And so really what you're going to look at is maybe, that's the wrong one. Like, oops. I'm not going to be able to change that. Oh, wait. Let me do this one again. So you're looking at, I don't know. I don't think it can get down there that fast. So this will probably take 2 weeks to get down to here, right? So as a bull now, that's what you want. And then the bears, like I said, we already had the bears trade plan set up a week or two ago. And that is something that we did at Trader's Way. Again, it's not like it's set up that way. We analyzed multiple levels of resistance and came up with very logical targets based on previous price action, based on weekly pivots, based on monthly pivots, based on whatever, fundamental analysis and seasonality. And we said up here would be a terrible place to buy and potentially an opportunity to sell. Okay. Yes, Luis, absolutely. The reason I don't cover dailies as much as I used to, FX Bootcamp used to be open 16 hours a day, right? So you could sit and do something like, let me just pull up a different chart here. Do this one. You could sit. Oh man, our trade was great. Look at that. It did make the 382, right? Oh, we'll have to go back to that. Anyways, you could sit for 2 hours, 3 hours, waiting for one trade set up on a daily pivot. And I did that for a decade. Pivot clusters, Fibbits. Which one should I do? Guess we'll just do this. Okay. You do it like this, and you would set it up, and you wait. Because I only do an hour and a half a day now with a group, I'm not sitting, like, I'll set up technical trades with you and say, if you're a bear, this is your sell zone. If you're a bull, this is a good buy zone based on generally accepted technical analysis techniques. It's not, I don't even have an opinion. The reason I don't have an opinion, it's like being a concert pianist. You put Mozart in front of them, they play it. You put Beethoven in front of them, you play it. There's no debate. It's just solid. In this case, I look at the charts as solid technical analysis, right? So, so for example, I could say, you know, this is a supportive area. Done. Right? It's not even an opinion. Right? Done. Okay? Done. Okay, so whatever. But anyways, so teaching the technical analysis and helping you identify places like support and resistance, because we know if you're a bull, buying at resistance is a terrible idea, right? And we also should agree, or I think we would agree, that when you're at support, it's a terrible place to sell. So to reverse that logic, you could say, well, if it's a bad place to sell, it might be a good place for bears to take profit because they realize we're getting into, you know, places where more bears are not going to jump in. So that could be a risk to your current position, because let's say you put one standard lot on a trade. After you did that, and after it's entered in the market, you're not influencing it anymore. You can't say, well, my one trade's in it, so it's going to go farther. Even if you were the only person in the world in the trade, the only way to get it to go further is to get more people selling it along with you, or more people buying it along with you. You need more people to keep it moving. So if you're in a place where you're looking at the chart and you're like, well, nobody in their right mind would sell it here. Well, how do you expect, if you were a bear, for it to continue falling if you look at it and you're like, no one would ever sell it down there? Well, that means that's probably where it's going to stop falling. Maybe you should take some profit. Now, if you can identify that as a place where bears would probably take profit because no one in their right mind would sell it, well, someone in their right mind maybe could consider buying it. Doesn't mean they should, doesn't mean they have to, but someone would probably say, oh, bears are going to be vulnerable here. I'm going to chase their stops, or I'm going to hunt their stops. Right? And then you get long and you chase them. And then what if you said, well, as a bull, what if I saw a double bottom at an area no one in the right mind would ever sell? Now you have a reversal pattern on top of support you identified. Now we call this a trade plan, right? And all of a sudden things go more and more in your favor. So I can do all that with you and then be done for the day and say, well, good. Now you know where, you know, bulls live and bears live, or where bullish trends die and bearish trends die and all that kind of stuff. You're on your own. Back in the day, we'd sit there and say, look, this is resistance up in here. This would be a sell zone. And then sit there for 4 hours while nothing happened. Right? All right. But cool. And just in case you wondered, that's a sell zone for today. Yep. But the green zone is where you're supposed to take profit. Unusual day. Yeah, that's called non-farm payrolls. Gorgeous. That 382 worked, huh? 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 Come on. What? You're going to say, oh, Wayne, well, it didn't do the 619. That's the plan we had, wasn't it? Sell a retracement somewhere between the 382 and 618 Fibonacci retracement, ideally off of a rule reversal. And after a couple of minutes, 2 or 3 minutes, after 2 or 3 minutes, you should be able to move your stop to break even. 1, 2, 3. So you stop, right? In 3 minutes, you stopped at a break even. Look where I projected. Look where it's stopping. Right? Huh? Neat, right? So let's go further out. Do you think it's going to get down to bearish support? That's this gray area. This is, if that's your target, then you're trading price action along the way to get down there, right? You know how to trade price action? Okay, so you have this down, 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 up, up, sell off this old area here. I didn't say it, I drew it, but if you don't know what I'm doing, then you didn't get it. But the way the price action works is when you make a lower low, you look left off the old support, drag it to the right, that's your new sell zone. Okay, so let's continue this theme. New lower low, look left of your old support. This is your new sell zone. But you knew that as soon as it made this bearish engulfing candle. Okay? New lower low, look left, drag it across, that's your new sell zone. Okay? New lower low, so on and so forth. Okay? Now I'm wondering if we're going to get a bigger correction than normal, and that's the trick with price action, because some people are trading it on a 1 minute, some people are trading it on a 5 minute, and the 5 minute guys need their pullbacks, and it could be even a bigger one. A 15-minute trader is going to want their pullback as well. Gee, I can't even zoom in further than that. All right. But what you want to do is look at this chart. I'm trying to back out here. Look at this chart and ask yourself, are we going down to the gray zone? Yes or no? If the answer is yes, then you have to say to yourself, what are you going to look for on this 5 minute chart or a 1 minute chart for your next opportunity to sell down into that zone? Okay? LP, why don't you visit tradersway.com, open a demo account, in the demo account back office, there's a button that says live webinars, and you can work with me every single day for years and years and years if you want. And I'll do my best to help you improve your trading skills. But yes, there's a lot more to what you, a lot more to it than what you know. We can work on it together. Okay? So this is a big if. If we can stay below the gray area, right? If we can stay below that gray area, it's technically important. It means we're going down to the next gray area, which is our target. So wouldn't it be nice to know if we're on our way to our target? Gee whiz, now it's freezing cold in my office. Okay, real battle going here. Brendan, I wouldn't make too much out of that. But if you're worried about it over the weekend, yeah, then maybe you shouldn't be holding over the weekend. Hey, Mo, how's it going? Cool. Hey, again, if you haven't done the thumbs up, would you do that, please? It shows a lot of respect, not for me, but to FX Street. It says that they host wonderful webinars, and it's important as far as the YouTube algorithm and ranking and all that kind of stuff. So out of respect for FX Street, would you give them a like for hosting us today? In fact, I'll double check that I've liked it. Yeah, okay, I just liked it myself. So again, thank you, FX Street, for being wonderful hosts. Again, I've been doing webinars, and then even before webinars, I've been doing events with FX Street for, I think, 14 years. Yes, Stone, that's right. All demo account and live account holders absolutely work. They work with me every single day. Okay. I'm not going to tell you what to do, but I will teach you technical and fundamental analysis and other proper trading habits. And I promise you, I won't hype you into trades. I think that's disgusting. But I will teach you how to think and analyze the markets as an independent trader so that you can make your own decisions. Right? I promise you that. Okay, this is technically important here. If it breaches above, if all of a sudden, like in the next minute or two, we get green, 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 then I think we should back out and analyze this from a higher time frame. If it goes red, 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 it just means we're on our way down to the target I've already explained to you, which is down here basically. What is it, 1550? So we're in a very important deciding spot here. You're opening a demo account right now. Cool. Welcome to the family. Okay. Let's do some yen pairs while this works its way out. Or do you want to do pound? Let's do pound. All right, this is pound dollar from Wednesday's trade. Okay. On Wednesday, actually on Tuesday, we identified this level and this level as likely support. Okay. Then on Wednesday, we got the attack on support. You can see we hit both levels, which then set up a rally. Then we rallied up into our short-term bullish target. So then I created a Fibonacci retracement to catch a roll reversal. At that time, I guessed about 50%. I said I would have liked 618 actually, but I just don't think we're going to get it. So I guessed more like 50%. That's pretty accurate. And from that 50%, it should project us up to a 1382, which also has to happen to be a cluster of monthly resistance, weekly resistance, price action resistance. So I said, yeah, that seems to be pretty good, around 130.50. And that was back when we were at 128.80, and the original setup was 128. Cool. So up 100, down 50, up 100, down 50, up 100, something like that. Do I trade anything else besides euro dollar? We do every single day at a bare minimum. We do gold and oil, all dollar pairs. Excuse me, all dollar pairs and all yen pairs. And then if you want to look at certain crosses and stuff, you can ask, and generally I'll look at them. We also do a peso trade once a month based on flow, but it's only a flow trade. It's not really technicals. We cover a bit of everything, right? So anyways, new higher high, look left, drag across, that's your new buy zone. So for me to update this, let me get that out of the way. Okay, we have this so far, you can see it. So then you'd look left, drag it across. So now this would be your new buy zone, which we're at in the moment. And that's how we should end the day, is the thought. Okay. So that's pig dollar. Aussie yen. Okay. Didn't get either trade really. So there were two trades. If you're a bull, even though this is obvious support, the idea was let it break because we're consolidating. So let it break. I mean, you're giving up opportunity, but you're not taking opportunity, right? So it's, your opportunity cost is missing it. But anyways, let it break, pull back, roll reversal, and then long. And that's a very ultra conservative trade because you're letting it break out first. You're not guessing. You're like, oh, I bet you this is going to go up. No. Let it break, catch the pullback, and on. And the reason for that is, technically speaking, this is still bearish. Higher high, higher low, higher high, higher low, higher high, higher low. And you can see we were selling this 2 weeks ago. So it makes sense that we should still make a lower low. So why would you be overly aggressive in a downtrend? Well, you shouldn't be. Okay? So that's what we reviewed. On the other side, I thought, well, that's kind of interesting because you really want to sell up here. That's where bears want to sell. Okay? I got caught on a monthly play, which I guess really set up here. What we did is, this is the weekly sell. And the weekly sell took over the monthly sell. And I think I was so intrigued with this perfect cluster. I mean, it's not perfect there. Kind couple of pips apart, 10 pips apart, or is it 1 pip apart? I think it's 1 pip apart. Anyways, there's a cluster of weekly sell. That's the perfect weekly sell. And that's an awesome monthly sell. So I'm like, oh, if it went up there, I would love to sell. Well, what it did was it kicked off the weekly sell, not the monthly. Which means whoever was front running the monthly got it. And see that it's this weekly one that worked, right? And well, I guess I wasn't that bearish. It makes sense to be bearish. It's logical. I mean, the trend is bearish. I get all of that. Doesn't mean I want to be bearish. So anyways, I was kind of hoping it would break and pull back. But if you were a bear, aggressive bears got paid on this one, and it's moved down to the next level, right? So now how do you trade this? Okay, well, let's go for this. Okay, so let's start from here. New lower low, right? Look left, drag it across. That's your new sell zone. New lower low, look left. This is your new sell zone. Okay. Higher high, look left. That's probably your buy zone, or this might be a buy zone. But bears at the very least, should grow cautious. You might have been aggressive here and 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 here, all completely justified for aggressiveness. The fact that it made a higher high on this time frame means on this time frame, which means in the short term, on the 15-minute chart, for the next 3, 4, 5 hours, you should be more conservative than you've been. AKA selling a higher high is not the same as selling a lower high. You should back off. You should adjust. Okay? Another way of saying it is bulls can start buying if they wanted to. Okay? Now go to the hourly chart or 4-hour chart, and on those time frames, it's still just simply maybe bearish. So for example, the new conservative trade plan would be something like this. And what I'm trying to highlight is you're probably not going to get it today, or if you do, you'll get it at New York close, which is what, 6 hours from now? 6 hours from now? You know, if you find yourself kind of in this area, let's call it 79.50 to 79.90. Now let's just call it this area. If you're here around 79.50 in the next 6 hours and you're a bear, that's probably going to be an opportunity for you to sell. You have next week's pivots, you have this month's pivots, you have the roll reversal, which would create a lower high, lower low, and you should be fine. But I wouldn't play this week's target. I'd play next week's target, which is actually this month's target. So if I were you and I was a bear and I had the opportunity present itself, selling around 79.50 would be all right, and the target would be 78. So only 150 pips, but you'd probably hit it by Monday or Tuesday and be done for next week. Mr. Ed just opened a demo account. Man, I turned the air conditioning on at the beginning of the webinar. I'm starting to get cold. Okay. Very cool. I think we caught most of this. Look at that counter trend CAD trade we talked about. But now it's setting up maybe a buy zoning. So we did most of this stuff already, right? So let's go over to the yens. I'll tell you what, let me take a 90-second break. I might reload my coffee or open up an energy drink. I might eat a snack. I have an apple and a granola bar. And either turn the air conditioning off because it's freezing cold in here. So it gets hot because of the soundproofing, but then once I pump it full of air, it gets cold. So basically my office, under the drywall and paint, is an ice cooler. It's crazy. But why not? The guy was soundproofing my movie theater. He's spraying all this, and he's like, "Do you need anything else sprayed while I'm here?" I'm like, "Oh, wait, that's true." I'm like, "Can you soundproof my office?" He's like, "Yeah, I can soundproof your office." I'm like, "Well, why not?" So, anyways, I work inside an igloo now. So, give me a 90-second break, snack break, coffee break, change the temperature break. We'll come back and we'll do all the yen pairs. And while you wait, maybe visit tradersway.com, open a demo account, maybe do a little like or thumbs up. Just 90 seconds, man. Don't freak out. 90 seconds, we'll be back. Thank you. Thank you for hanging with me. I'm back already. Although I still need to eat. I was just laughing at that guy that was in my mind from the beginning. He was heckling me because I'm not rich enough for him. I have to be richer or something. How rich does someone have to be before you've earned their respect? John's got a commercial grade portable air conditioner in your trading room. Yeah. Well, I used to have a setup like that. But now I don't need it. All right, almost done. So I hope you guys trade yen pairs. Someone here, might have been John too. One day he said to me, "Oh, I don't trade yen pairs." I fell out of my chair. Like, you don't trade yen pairs? Maybe it wasn't John, it was somebody else. Like, wow. Never met a person that doesn't trade yen pairs. All right, so let me know what yen pairs interest you most. We'll cover them all, but just let me know, what yen pairs do you like the most, that attract you the most? That guy was just so funny. Well, if you were so good, you'd be retired now. I'm like, dude, I am retired. You know, it's funny, like Harvard, for example, since June, Harvard has cost me $20,000, and I'm a part-time college student. Just since June, what is it? September now? Since June, I've spent $20,000 on grad school. Moving to this. That was you, Johnny boy? Wow. It was just some sort of granola bar. All right, good. It's funny now. I think there might be more than a 2-minute delay. I think it's more like 4 minutes now. So, anyways, now we know. MoveOn.com. What time is it? We have 1 more hour. Ding, 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 ding. Stock market just opened. We have 1 more hour. We'll go through the yen pairs. I'll address any questions that you have technically or fundamentally. All that kind of stuff. If you have any questions about like the courses on FX Bootcamp or something, I can reference that. Just whatever. You're the boss. All right, let's start with the beast. Clearly, I had a more optimistic view for the pound yen. Our support is still held. Is this important? Yeah. It's important in the sense that it hasn't collapsed. And of course, I can drag this even further. So I'd like to be bullish on this, especially after a bullish move. Really bummed that it didn't work out. And notice, though, that we're not even using month or weekly pivots per se. The only real pivot here that on a weekly basis that was respected was the M3, which bears are living. Okay? So we knew this on Monday. Well, you probably weren't trading Monday. So we knew on Tuesday that that's where bears would live. So I can confirm that after that big move, bears were there. Cool. But here's the problem. Bulls were supposed to be living here. Okay? You're like, well, that's pretty close, right? But I wouldn't have thought here. Now, there might be other reasons, which is fine, but I look at this and I say, they're not using pivot points. Or I should say it differently. Bulls are not using pivot points. AMFX says Harvard was a waste of money. You know what? I'm not even taking Harvard for any particular like professional reason. Harvard is not a waste of money. It's a very, very interesting, intriguing place. I've made really, really good friends. I've learned a lot. I have access to the most valuable resources in the world. In fact, yesterday, the top 50 university list was released. I don't know who does it, US Today or something. Harvard, again, #1 school. And it's an amazing place. I mean, it's an honor to go there. So, yeah, if you need to, it's like Forex. If you need to make a lot of money, you're probably not going to make a lot of money because you're just in the wrong place. Am I going to get all my money back? And am I going to make money by going to Harvard? No, but it was an honor. They said, would you like to go to Harvard? And I said, yes. And then I said, how much money is it? I mean, it was inconsequential. But I'm in a place where that's cool, you know? And no, I don't have a yellow Lamborghini. I don't even own a car. I don't need a car. Right? So again, whoever was heckling me earlier, I don't know how much money I'm supposed to have for you to respect me, but I don't think money and respect have anything to do with anything. I know some very, very wealthy douchebags. But anyways, Going back to this, I look at this and it tells me bulls are not using pivot points. And so I don't know how to plan it out. I have to come up with other reasons. And that just issues sort of caution. I do not see if bears are using pivot points. Okay. So that's interesting. So I was hoping this up, down, up was going to work. But remember, bulls aren't using pivots. Shoot. So I'm not sure what they're doing here. But we did hold on this monthly pivot for quite some time. So if you took the shot here, it's pretty understandable. But there is a lot of caution on this setup. Right? There's a lot of caution on this setup. So what do we do now? If you're a excuse me, if you're a bear, it's probably time to get pretty serious about looking for a short. We're kind of in this situation here. I don't want to put too much emphasis on where these actual blue lines are. That's not. That's not. Man, I got that granola bar in here. Right? Anyways, it's not the blue lines that are important. It's the reason I draw these is if you're a bear, it's like a reminder, like training wheels to say you want to stay a bear as long as it's not making higher highs. So like if you were way up here, it's no longer as bearish as it used to be. If you're way up here, it's definitely not bearish anymore. Okay, so you do this to say, okay, I'm trying to set up bearishness. And then you want to set up based on next week's sell zone, which you're in now. So if I were a bear and I were to sell, I would probably like to sell anywhere in that box. Let me draw the box. Okay. All of that's fair game. Okay. And you probably want to sell, because it's Friday, you want to sell in the next week's target. So you're selling around 44.50 and your target's going to be 42. 44.50 to 42 is what I would expect out of that. And down at 42, you have a cluster of next week's target, a monthly pivot, a monthly buy pivot, by the way, and the bottom of the channel, which again is not that big of a deal, but because it's there, I'm going to make a big deal of it. But it's all nonsense anyways. It's all confirmation bias, but it's something, right? Yeah, John, I agree with that. It's amazing how often, though, that the news moves everything in favor of that trade plan anyways, right? All right, so anyways, that's that. But I bet you anything you can find something better to be trading. We'll move over to CAD Yen. Okay, remember CAD is weak. What do you want to do here? If you're a bear, I would look at selling this 4 hour 21 if you had the opportunity. If you were a bear, an aggressive bear in particular, and your target is, well, I already have a target for this at that level. It's here. So our target from 2 weeks ago was 82.25. But let's just call it 82.50 or even 83. So we're at 84.50 about now. So maybe you get an up and a down. Okay. Now a true bull, however, is going to counter trend this. Okay. But, right, so they're going to look at this as support. And they're going to want up and down and up. Okay. I get that. Okay. It's not a good buy zone, but it's basically the only buy zone anytime soon, right? Well, going back to like John's comments and some of the other people's comments about yens, I like the yens because, first of all, they're very seasonal. And I think a lot of the seasonality has to do with the difference in fiscal year between the United States and Japan. So you get two different types of business cycles that are 4 or 5 minutes apart. Sorry, 4 or 5 months apart, right? So that almost is like a spread between the two business cycles, and you can trade that. So that does create some seasonality. Also, because the yen is typically, or traditionally, or at least as long as I've been trading, a funding pair, that they tend to have larger average daily ranges, right? So when you're right, you're typically more right. So for example, back in the day, like let's say if you longed euro dollar because euro was strong, you might make 75 pips on a good euro dollar day, but you might make 125 pips on a good euro yen day. Okay? And there was a time the euro yen was highly, highly, highly correlated to the S&P 500. So so if the S&P 500 was going up, you were just buying euro yen, and great, right? The Dow would be up 100 pips, you'd be up, or the Dow would be up 100 points, you'd be up 100 pips. Do typhoons cause currencies in general, right, move? And sure, yes. Sexy Crabber says the Japanese population sending money home to aid the recovery efforts and stuff. Yeah, absolutely. You might also want to buy Japanese construction company stocks. Find out the companies that get the big projects for, cleanup efforts and stuff like that. Their stocks will tend to move as well. So one thing I've recommended a few times over the years, I guess I haven't done it in a while, so I'll restate it. One of the things you can do if there is such a situation going in Japan, and I'm not aware if there is, if there has been another tsunami or a typhoon causing problems or tsunamis or whatever, but when you get into that situation, analyze the situation. Okay? Over the next 2 or 3 months or weeks or whatever it is, if there's a major disaster in Japan, for example, and there has been multiple times since I've been trading over 15 years, right? Analyze what happens. Look at the stock market. What stocks in the market tend to appreciate, which ones tend to depreciate. And that's the scenario. And then sort of dig a little bit deeper, like why did some stocks move up? Why did some stocks move down? And try to understand that. Okay? And then other type scenarios. Did the yen get strong or did the yen get weak? And put it all together in a book, like literally write it down and say, well, the last time, an earthquake happened, or the last time a tsunami happened, or whatever, because you can go back in history and do your research and say, this stock went up, this stock went down, this commodity went up, this commodity went down, this currency went up, this currency went down. Write it all down, and then put it in a binder, like a procedure, disaster recovery plan, right? So that in the future, down the road, when there's another earthquake or another tsunami or whatever type of situation, you're like, and it comes across your terminal, bling, 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 oh, earthquake in Japan. You're like, oh my God. And you grab the binder, flip, 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 flip. All right. Right? Buy, buy, sell, sell, buy, sell, buy. Done. Boom. Okay? And have that for what happens if there's strikes at copper mines in Chile. What happens if there's power outages in South Africa? Right? That kind of stuff. There's a terrorist attack in London. What are you going to do about it? Okay? You're like, oh, what? Something, terrorist attack? And you're like, oh, grab that, flip, 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 flip. Well, last time that happened, these things occurred, right? So that means you have to literally be an analyst now. Go back in time when the tsunamis hit Japan. What happened literally the same day in the stock market, and bond market, and currency markets, and commodity markets, and track that out. What happened the same day, the next day, when if the markets were closed, when they reopened, what happened? Put together a three or 4 week plan, or what happened within the 30 days of the event. Document it. That's called research. Document it with a plan. That's what a professional would do. Because I'm telling you, when news comes across that there's a major tsunami on the way to Japan, there's hedge fund managers that just pick up their book and they're like, I got the playbook for this, and off they go. So you can do that for yourself. Okay? And therefore, you don't need anyone's advice. You don't need anyone's opinion. All that kind of stuff. You know what to do based on your own research, and you believe it here in your gut. You believe it here in your heart. You'll know what to do, and you're confident in that because it's your own work. It's your own opinion. And you've earned it. And like I said, I did a similar conversation, I think 2 days ago at Trader's Way in regards to planning for hurricanes and tracking them on the NOAA website and stuff, and being able to make trades or investments 2 or 3 days before you hear about it on CNN and the Weather Channel, where there's some guy standing on the beach, ankle deep in water, and he's telling you it's the worst hurricane he's ever hit the coast. This is the worst hurricane, because every hurricane that comes along is the worst one that's ever happened, right? So by the time there's the news reporter screaming into a microphone, even if it's a fake hurricane, oh my God, it's ankle deep now, right? They hype it up, and then that hype moves the markets because most traders are stupid, right? So once they see it on TV, they react and probably overreact, right? They're susceptible to the hype. But if you were tracking it off the coast of Africa and you've analyzed what happens based on the trajectory, and remember, NOAA, the National Oceanic and Aeronautical Administration, they tell you about glide paths and projected wind speeds, and they'll do all these kinds of things. And that can tell you things like, should you buy the dollar, should you sell the dollar? If it comes in low in the Caribbean, right? If it comes in, let's say, under Cuba, well, you would buy oil futures, wouldn't you? If it came up above, wouldn't you buy frozen concentrated orange juice futures? Right? Like, of course you would. Like, duh. Right? But you should all have that. Now, Kevin Starr says, can you find that historical data? Yeah, sure. Find out what stocks did, like what day was the Japanese tsunami. Find out the day, and then look at the most actively traded stocks over the next 30 days from that moment. Okay? You see what I mean? You can find that data. That's public information. Sure. Not a problem. What about like the satellite stuff I'm talking about? The government gives you that for free. Okay? Cool. I noticed some of you guys are bailing out because I've been talking for almost 3 hours. Cool, man. Make sure you give a like first. And it'd be very nice if you visited tradersway.com and opened a demo account. Be nice to see you on Monday. I'm not rich enough for the guy heckling me. I haven't earned his respect. He says if I was so rich, I wouldn't be doing this. But I'm on my way to Napa to buy wine for my wine cellar. I don't know if that's rich enough. Sorry, dude. I'll work harder. But Monday morning, I'm waking up at 4 a.m. to do my webinar from Napa because I love working with you guys on improving your skills and your knowledge of being not just how to do technical analysis and get into a trade, but really how to be a trader and how to really love being a trader, right? So I will wake up at 4 o'clock in the morning on a vacation, 4 o'clock in the morning, to do my 1 hour webinar with you because you've earned my loyalty and respect for you. I'm dedicated to working with you because you take this so seriously and you try so hard, and I know it's worth the effort because I've been through it myself. So I'm there for you, man. I will do that. I will go on vacation and not take days off. When was the last time I took a real day off? Now, I spent the summer at Harvard for summer school, so I lived there for a month. Okay, that's not vacation, really. Other than that, I've never taken a vacation day. Right? I've traded with you guys from Singapore. I've traded with you guys from Hong Kong. I've traded with you guys from South Africa. Right? And that's all in the last couple of years. I don't know if London? London, Paris? No, I don't think. I think those were weekends. But anyways, days off, unacceptable. But do you guys remember that? We're at the conference room on the 140th floor of the Ritz-Carlton in Kowloon with a view of Victoria Harbour and Hong Kong across the water. That's fun. Will Traders Way start taking debit cards again? I don't know. Contact me. I'm just an analyst. Oh, AMF said you should be a teacher at Harvard. Yeah. I'm older than a lot of my professors, not all of them. I'm about that age. I've had some pretty funny experiences. I've had parents look at me like, what's that guy doing here, right? I remember this summer was pretty funny because I'm coming from class. I lived in the dorms, right? I love doing that kind of stuff. I just love it. So anyways, I'm walking back from class. Boom, I got my book bag on. I'm feeling young, right? And all this kind of stuff. And two pretty girls, maybe 20. They want to talk to me, right? And they're like, hey, can we talk? I'm like, okay. Right? You forget that you're covered in gray hair and fat, right? All of a sudden, I'm 20 again. Like, oh man, these hot chicks want to talk to me. So I go up there. They're like, yes, we're doing research for our psychology class, and we're doing a skit about grief, and we're doing a little documentary about our father dying. Would you mind if we recorded you? And I'm like I'm your dead father? They're like, yes, sir. You just called me sir. You want me to be your dad? I'm like, oh my God. I'm like, sure, baby doll. So anyways, they took a photo with my arms around them like I was their dad. Right? So anyways, yeah, so but look, I think, what was it? It's 3% of people are accepted at Harvard, right? 3%. No idiots apply to go to Harvard, right? Only smart people will apply to go to Harvard. And 97% of them are rejected, right? Except for my program, right? Because I get to study at all the different schools. I'm taking a class at a business school. I'm taking a class at the management school, and all this kind of stuff. Anyways, 98% of the people were rejected for my program. They accepted 16 people. Now there's only 10 left, and they've canceled my program. They've only done it. I was the first year. They tried it a couple more years to accept people like me, and it turns out it's just too hard. It's actually been shut down, deemed too difficult to do. Love it. So I'm in a program that's been canceled because it's too difficult. I love that story. I love that story. It's too difficult. I'm totally in. I'm an A student, by the way. And it's just impossible, is what Harvard has now said. It's too hard, too difficult. Yep. Love it. Perfect. With this semester, I'm doing accounting at the business school. What's my other one? Real estate development, which is a management class. So I'm doing real estate development and management. I'm doing a class on managing endowments for things like museums. And what's the last one? Oh, it's an economics debate class. So we're doing, last time was minimum wage. But anyways, so I'm doing sort of a class with someone that used to work at the New York Fed. And we're going to manage universal income is this one. So I met with her last semester and we debated minimum wage. And this time I'm doing another class with her and we're doing universal income, which is similar but different. So I have to do all the research to figure it out and then I have to argue and all that kind of stuff. Anyways, awesome stuff. Fun. Like, is it worth it financially? But like, I don't watch TV, right? So like, what do I do for a hobby? I'm a grad student at Harvard, and it's awesome. I love learning, but it's so much work. I do 30 or 40 hours a week of school. Good thing I'm retired. When was the last time I had a job? 20 years ago, I had a job for 3 years. I think I've had 3 jobs in my life. I worked at NASA. I worked at Cisco, NASA, then Apple, then Cisco Systems. Then I started my own company, ran that for multiple years, then became a venture capitalist, which was a job, so that was another job. And then I became a Forex trader for 20 years. Done. Okay, let's move. Is that right, Alton? Did you really? That's killer. Alton dropped 10 lots on the trade plan, made 50 pips, and was retired for the month. Booyah! Well, Alton, make sure you open that Trader's Way account, huh, buddy? Hey, Beatrice, Tanzania. $69.1 on the. Okay, that's fine. All right, so someone wanted to do an update on euro dollar. Sure. Okay. So we had that big move back, which remember I told you in here. If it moves up, you should get out. You're welcome. Now we'll see if it's rolling around, right? I think with non-farm payrolls, I'd like to just, once it's dead, walk away. So we did that. Let's go back to the end pairs and finish that up. What do we want to do? We did Aussie, didn't we? We did Aussie Yen, didn't we? Thought we did. Yeah, it's set up for a new sell, really. Because I don't like to set up the counter trend. I can see the counter trend, by the way, if you know how to swing trade, but I just don't like it. So I think I have it on the other chart, but just to remind you, I think this is the safest, most conservative, straightforward trade. Do you have? Are you strong enough to be kind? Are you disciplined enough to be patient, right? To let this come up and then back around. Steam says, can I download your setup presentation? I think what I'm going to do, because I get asked for it all the time, and people get pushed here and there for it. I think what I'm going to do is I'm going to set up an area for you to access that just easily. I don't have that now, so maybe if you, once again, open a demo account at tradersway.com, in the back office, there is a button to attend my live webinars. So on Monday and Tuesday and Wednesday and Thursday and Friday of next week, maybe I'll have it set up. And you can say, hey, do you have that thing set up? And I'll give you the link, and you can download it, and that'll be that. If you don't open and you don't attend my daily free webinars for clients, then you can wait till next non-farm payrolls at FX Street, and I should have it done by then. What I'll do is I'll just give you a link, and you can download it, and not just the indicators, but also the templates, so that everything is set up and looks exactly like mine. You know, plug and play type stuff. Okay. So that's that. I kind of feel like we've run that course there. We can do the energy complex. Okay. So what this plan is saying is plan A would be to sell here. Plan B was to sell here. It just fell without me. So I apologize. This was all set up with the counter trend trade, by the way. Does anyone want to buy oil? Well, you would buy it at $66.75, or you'd buy it at $63.45. Okay. Okay. And you're like, well, isn't that first entry? Isn't that where we are now? Yeah. So now you move into a smaller time frame. And confirm it using technical analysis. That sounds pretty logical, right? Come up with the hypotheses and then confirm it with analysis. They call that the scientific methodology. So now you say, all right, so we're pretty close to my buy zone. Remember, it's not here or here or here or here. It's exactly that price. Well, maybe not exactly that price. What price is this? 66.63. So 66.66. Okay. So anyways, drop into this like 15-minute chart now and say, okay, we've already touched it. We've already hit 66.66. So we've had our double bottom. And notice it's not about that price I mentioned to you. right? You see this? It's hit it exactly. So that is confirmed. Done, confirmed. There are bulls in this market. Now I have to redo this, right? There are bulls in this market. That's the price you wanted. That's the price you got. So double bottom. So there's two ways to trade a double bottom. One, you buy it now because it's simply a double bottom, and you pray it doesn't go lower. Or at least you put a stop loss and you say, well, if it goes lower, you're out. The second way is the higher high, higher low scenario. Remember, we're thinking bulls, right? So I'm going to put it like this. I'm going to put it like that. I get like this, like that. Where for ball bat, right? So anyways, that would be your plan B. Okay? And your entry would be that area, I guess is what I'm trying to say. Okay? Which one do you do? Well, that's your decision. We're all different on that. But that would be the logic. If you felt like you wanted to be a bull, now the market is not bullish, so this is an aggressive trade. This is less aggressive, and then the least aggressive is the higher high, higher low scenario. Let's draw it like, I'm going to draw it like this. Okay? And buying the higher high, higher low is the least risky, and it would look like that. So risky, moderately risky, less risky. This one pays the most because your reward is a function of risk. Okay? But really, if you bought it here, your stop would still have to be here, right? So this one risks less pips, but you're more likely to lose. But since you're not risking much, you don't lose a lot. And if you're okay with that, you say to yourself, well, as long as my losses are small and my wins are big, I'm okay. Now, that means your entry has to have very few pips attached to it. And you also, because of that, are forced to hold your trades longer. So that means you're going to have lots of little losses. You're going to have lots of break-even trades. And the rest are just huge wins. What works better on the long run? Well, you might have already tested this whole idea of big losses and small wins, or a whole bunch of small losses and small wins. And you probably have discovered one is losing and one is break-even. So if you've already confirmed that emotionally and intellectually, then maybe try it my way, where you have a lot of break-even trades, a lot of small losers, and then 30% of the time you have some, home runs. You might actually do better. But to do that properly, you have to have solid analysis and solid trade plans and be totally in control of your trading. And you don't say things like, oh, well, I guess it's going up now, I should buy. Boom. So reactionary. There's no professional on the planet that's reactionary. Right? Fund managers can tell you the 3 or 4 things they're waiting for next. Plus, a fund manager spends a lot of their time talking with clients. A significant amount of time talking about clients. Which means they talk about things like their outlook for Brexit. Explaining what's going on in Turkey. Because they're going to say, oh, well, I heard on CNBC the Turkish lira. What's going on in the Turkish lira? Oh, well, yeah, that is very interesting. It's not really something that we focus on because we're looking at mature economies, what we call major currencies, that are moved more by central bank policy than they are about crises and stuff. So, but let's talk about it. It really has to do with the style of economy they have, their lack of hard foreign currencies, in particular the majors that we trade, right? And also the fact that it's a developing country that is typically pays 10 or 20% on borrowing money from a bank. And then they found themselves in a situation where they could go to Germany and borrow money for free, or go to Switzerland and get paid to borrow money. So here's a mentality. Most of your adult life as a business professional, you've had to pay 15 or 20% interest on loans. And then all of a sudden, Switzerland is paying you to do a loan? They're like, please borrow our money. Here it is. Plus, we'll pay you on top. We'll throw in some extra free money. Or you go to Germany and they're like, you need to borrow money, Turkey? Not a problem. You're building a strip mall in Ankara? Great. Sounds awesome. Here's the money. It's free. Well, what do you think a Turk's going to do? Free money? Then he leans over to his buddy. He's like, look at this German. This guy's nuts. He's going to give me free money. Turk says to one Turk says to the other, take it. Right? Like that one joke video on YouTube. Or reparations. But anyways, so all of a sudden you're like, free money? Shoot, I'll take free money. So now what? Guess what? Turkey has too many business loans in foreign debt. Well, why do you think that happened? Because the money was free? Of course. So Turkey's going to get into some problems. Some German banks are going to have some problems. Not that shocking to me. But anyways, we'll get all of it, You should have a plan. You should have done the analysis. You should be able to sit down and talk with a billionaire about what you think is going to happen over the next 3, 6, 12 months, 2 years. Be able to talk about the diverging central bank policies of the ECB and the Fed. You should be able to talk about the elections coming up in Sweden this weekend. You should be talking about rumors of policy change at the Bank of Japan, but why they can't really do it, or why the Eurozone can spend 2 trillion euros to create inflation, and there's still no inflation. Well, what went wrong? When will inflation come in? When will the ECB stop quantitative easing? What is Japan going to do when they own 70% of the stock market? Well, let's see. Well, what does the Fed do when they own $3 trillion in bonds? How do you get out of that without crashing the market? Oh, you do nothing, because every bond has an expiration date when they mature, and they just die. They just poof, disappear. So if you just wait long enough, whether that's 30 days, 1 year, 5 years, 15 years, 30 years, eventually, whatever the debt is, it will mature. So in 30 years, everything on the Fed's balance sheet now will be gone. Probably significantly less than 30 years, but let's say definitely 30 years, because they don't own any 40-year bonds. So every single bond on their balance sheet will mature, and poof. Now we got a normal, healthy balance sheet at the Fed. What's the Bank of Japan going to do when they own 2/3 of the Nikkei? When does a stock just disappear? It doesn't. They own it in perpetuity. They own it forever. So how do you get rid of it if you're worried about the size of the balance sheet of the Bank of Japan? How's the Bank of Japan going to sell all that stock without crashing the stock market? I don't know the answer to that. How are they going to get out of it? How are they going to unwind? Very interesting stuff. And you say, well, you have billions of dollars. I have a wicked smart mind. Maybe we can work together and take advantage of that situation. Well, if you're going to get to that point, you're going to have to think more about trading and investing and macroeconomics and central banking policies than how quickly you can scalp and make enough money to buy your yellow Lamborghini. If you have $1,000 and you want to buy a yellow Lamborghini this year, get a job. Ideally one that pays you more than $250,000 a year. You should look at Forex as a business opportunity, and that you have the real possibility of making very significant amount of money over the course of your lifetime. Now, if you started an import-export business, or you started a restaurant, or you started a corner store, or you started a mechanic shop for fixing Lamborghinis, and you hired some mechanics that know how to fix Lamborghinis, great. But you're probably not going to make significant money in your first year. You might even lose money. Or your second, third year, fourth year, fifth year, you've developed your customer base, you've developed a reputation, you got into the groove, and things start getting better and picking up steam, and things are starting to work. And by year 10, you probably feel really good about where you are. You look back and you're like, wow, I took a lot of risks for starting this business. Good thing I had a long-term view. Good thing I had a long-term game plan. Lucky I love doing what I do. I'm lucky that I had enough money to bankroll this in the beginning, because you can't start a restaurant on the cheap, and you certainly can't start a restaurant on the cheap and then turn it into $1 million in your first year, right? None of that makes logical sense. So what does make sense? The long-term plan, the focus, the idea that you want to be doing this 10 years from now. So why would you throw down a ginormous trade today to get rich quick? What you should be like, think about that credo. Capital preservation is your number one goal, because and let me kind of talk about this. We have only a few minutes left, but I did a business planning retreat with myself 1,000,000 years ago. And I learned so much from this. And I spent like 3 days just on Excel spreadsheets and stuff. But I learned something revolutionary. I planned out 3 years of trading, day by day by day, assuming that on the long run, on the aggregate, I average minimal acceptable performance. So yeah, some days I'm going to lose money, sometimes I'm going to make money. But like I said, on average, it'll probably all average out. And I said, well, it'll probably average out around this minimal acceptable performance, right? So good. So I calculated that. If I had a mediocre day on day 1, day 2, day 3, day 4, day 5, and I planned it out day by day, Monday through Friday, 52 weeks times 3. So over 150 weeks, I planned it day by day. And I did it all where I said I started with this amount of money, and I started with this amount of leverage and this lot size, and it would calculate. So on day 89, this would be my projected lot size and all that, and it would spit out all this money. And I finished this business planning retreat, and this was very early in my career. And I finished the spreadsheet, and it told me I would make 158 quadrillion billion dollars. And I'm like, what? A quadrillion, billion, dillion, trillion, that's a lot more than I need. And I realized, I must be over leveraged. Because at the end of 3 years, I was trading like 1,000 lots. I was making $28 million an hour. And I'm like, oh my God, maybe I'm over leveraged here in the beginning, because it just doesn't play out. So I lowered my lot size and all that kind of stuff. I lowered it. And I said, well, maybe I should reverse engineer this. Let's say I wanted to make $100,000 a year or $1 million a year, whatever it was, right? And I go and I reverse engineer it, blah, 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 blah. And it turned out that on my starting level of leverage, lot size, relative to my starting account size, was ridiculously smaller than I could ever have imagined. And it just blew me away. So I'm like, so if all I did was map, something I would not even be happy with. I'm disappointed with that. But on average, if I average that out, okay, it's okay. At map per day, at this ridiculous little lot size, at the end of 3 years, I've hit my goal of making more than enough money. I'm like, and then I look back and I'm like, this day is like nothing. And the next day is like nothing and nothing and nothing. I'm like, every single day relative to how fast the account's growing is nothing. Relatively, right? And I'm like, oh my God, but then I hit my goal. I'm like, oh, I got it figured out. I should be conservative and ultra focused on not trying to make a ton of money, but just surviving long enough to get through the 3 years. And the compound interest and everything else takes care of itself. And then as long as I don't have bad days, and I can't have a bad day if I'm not trying to have a huge day, because remember, reward is a function of risk. So the only way to make a big, huge day today is take big risk. But this whole other thing told me if I never take big risks, if I just do my job and stay humble and focused and conservative and disciplined to get through 3 years, at the end of 3 years, I've made the big money without taking the big risk. I'm like, holy crap. That's how to do it. Stay small and stay humble and focus on the long term. And since then, I've been telling myself and every single person, hundreds of thousands of people now that have gone through my webinars, every day I say, stay small, stay humble, focus on the long term, never risk money you can afford to lose. Not because the NFA makes me do it, because it's a God honest truth. Like, it was revolutionary. Don't put yourself in situations where you'll lose a lot of money, because the big money is the long-term gain, right? The long-term game here. Getting through those 3 years and just doing your job. And it was so important to me. And that today individually didn't matter. And tomorrow doesn't matter because it's the aggregate. And now you're playing these laws of averages and you're more concerned about the level of risk you're taking because, God forbid, you have a bad day today and it'll take you 3 days to make up for it. But now you've lost 4 days out of your 3-year plan. You've lost 4 days in your 150 to hit your goal, right? So 3 years, let's say it's 150, 1,000 days, I meant, right? It's 1,000 days. You had one bad day, so you lost money. Took you 3 days to make up for that loss because you're staying conservative. So now you've lost 4 days out of 1,000, and the 4 days of lost income is more important than having one good day that's outside the average because you took a big risk. Because, well, what if it's the big loss? You don't need the big win today because the win takes care of itself. That's what I'm saying. If you can get through the 1,000 days just being humble and conservative, you got the big win mathematically designed into your strategy. It's there. You're going to make it. So you're like, what's worse is losing 4 days. Right? You see what I mean? Don't lose the 4 days by taking on extra risk so that you might make extra money, because it's way worse to lose money when you've already got your big money built in. Just do your job. And that's where you need to get to as a professional. And then look, 3, 4, 5 years from now, if you want to buy a yellow Lamborghini, buy your damn yellow Lamborghini. I don't even own a car. Okay? And so what real numbers? Well, why can't you do that yourself? First of all, I think the business planning and retreat was important to me because I put so much effort into it. Nobody told me. I didn't read it in a book or hear it in a webinar. It didn't exist. I went through a struggling period and I stepped back and I said, well, I've been very, very successful in life before Forex, right? I was a venture capitalist. I started many businesses myself. In fact, I was in probably 10 or 15 magazines as a startup entrepreneur before I even became a currency trader. And then in currency trader, I was on TV, been quoted by the Wall Street Journal, all this kind of stuff. I mean, but that was all Forex stuff. Before that, I was a success. So I stepped back. I'm like, I'm going through this back period. I'm like, well, what went wrong here? And what would I have done in my previous life to get through this challenge? Like, what did I do when I was managing a startup or doing my venture capital stuff, or when I worked at NASA or Cisco or Apple? Like, what do you do in these situations? I'm like, well, first of all, I need a business plan. And I'm a currency trader. Like, I don't even have a business plan. I'm like, that's probably a huge mistake. Like, I never thought about it before, but If I was a hedge fund manager, I would have some sort of plan and all that. So I'm a full-time currency trader. And by the way, this is what, 15 years ago, right? I'm like, I have to have a business. What goes into that? I'm like, well, I need a mission statement or operational direction statement. I need key result areas. I need business plan. I need planning to achieve each one of these KRAs or KRIs, if you will. And then I'm like, I need pro forma cash flow statements. I'm like, well, how do I do that? And so I literally spent I think I spent 3 days at the Ritz-Carlton in Half Moon Bay doing that kind of stuff. What is my mission? I invented things like the credo, capital preservation, and all that kind of stuff. That all came from that business plan. But anyways, and then working maybe the rest of the week just on the pro forma cash flow statements. And you figure things out like, how much money should you pay yourself? Should you pay yourself monthly? Should you pay yourself quarterly? Should you pay yourself annually? And if so, do you pay yourself 50%, 40%, 30%, 75%? Like, how much should you pay yourself and how much should go into the trading account? Do you understand? Like, once I created the models, I had to create maybe 100 different variables of different models until I found out, again, things I thought were revolutionary. The less I paid myself, the more money I made. Right? You understand that? So if I paid myself a certain amount per month, whatever, 5% per month versus just 5% at the end of the year, I would make way more money paying myself at the end of the year. Because the account would grow that much faster. And by the way, most of you probably are thinking, 50% goes into your trade account, 50% should go in your pocket per month. But then at the end of the year, you didn't make that much money. And then at the end of 3 years, your account didn't grow that much. So you're still not making that money. In my model, I found that, boom, if I could find a way to not pay myself at all at the end of the first year, at the end of the second year, I'm making probably 10 times more money. So that would tell me, like, live off my savings. Right? Don't take money out of my trading account. Or if you don't have savings, if you're not already wealthy, then you should do something like trade and have a job. But whatever you do, don't spend the money in your trading account. Grow it as much as you can. Or maybe trade for friends, families, and fools or something, or whatever. Increase your assets under management and don't withdraw, because the whole game plan is to increase your assets under management. But the point is, I spent a phenomenal amount of time doing this. But that's how you become a professional, right? And I hope you get the sense that I'm still passionate about all of this. But how can you be successful as an entrepreneur if you don't take your game to that level? And then how could you possibly be successful as a trader if you don't have that type of game either, right? Right? You see what I mean? But I spent that amount of time. I had that type of tenacity. I had that type of business experience from the real world, not as a trader, but as a businessman, right? Someone that has sat on a board of directors with George Soros. True story. I brought that to Forex. Now imagine this now, the person on the other side of your trade, like when you decide to just randomly jump into a trade, I might have had a plan for the last 3 days waiting to go against you on that. Like, I'm going to sell at that level, and you're like, oh, I think I'm going to buy. You made your choice in seconds or minutes. I was ready for days in advance. I'm probably going to win. And then, of course, I'm an idiot, right? There are traders, professional traders with billions of dollars behind them that are 10 times more powerful, and you're trading against them without even a business plan. You're trading against them without a long-term vision. You're trading against them without even a trading plan. You're trading against them and you don't understand fundamental analysis. I'm like, dude, they're going to crush you. Right? So you need to bring your game up to a whole different level. Stop thinking about getting rich quick. Throw yourself into an education. Hey, if I can go to Harvard for 4 years in an elite program and still have time to trade, I think you can too. Oh, and you probably have a wife and kids. Yeah, so do I. Is it going to be easy? No. But have a long-term plan. Get some real knowledge. Get some real skills. Get some real education. Study what you do. Identify your strengths and weaknesses. Actively work on very specific things. And get really, 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 really good at one little tiny thing in trading. And then another one. And then another one. 3, 4, 5, 6, 7, 8, 9, 10 years from now, you'll probably be pretty good. Or you'll bust out because you're not doing it right. Well, don't bust out. Focus on getting through year 3, year 4, year 5. And get better and better and better. Not just because you're trading. By the way, you can trade for 10 years. You can golf every day for 10 years and be barely a better golfer. I mean, train. You'll get really good at what you do. What is the minimum amount to start with? You can start with any number. But remember, if you're like, Wayne, I want to put $500 in my trade account and I want it to be 100,000 at the end of the first year. I'm like, no, that doesn't seem realistic to me. Okay? Here's what I would do. If you had $500, put that in a trade account and really, really focus on very conservatively trading properly for the next 3 years and building a track record of success. And prove that you could slowly grow your $500. Now, if you doubled it at the end of the first year, you'd have 1,000. Then you double it again at the second year, that's 2,000. And then at the end of the third year is 4,000. So you're going to have somewhere between $500 and $4,000 at the end of 3 years. So let's say you got it to $2,500. That's really good returns. Oh my God. And you did it over 3 years as market conditions changed, as policies changed, as event risks changed. And you can prove to a professional investor, or at least to a wealthy person, look, I very conservatively, over the long run, with very, very low drawdown and very, very low volatility over the course of a changing global market, conservatively but consistently grew my $500 account into $2,500 or whatever, right? Would you please consider investing with me? And that's how you increase your assets under management. So now you went from 500 to a couple of thousand. And then the guy's like, well, yeah, I'll throw 200,000 your way and see if you can do it again. Please stay as conservative as you did with your 500. Sure. 200,000 becomes 400,000. 400 becomes 800. But you're collecting 20% along the way, and that's probably enough to live on. Okay, I think I went too far. I apologize. I went 5 minutes over. 3 hours and 5 minutes. I hope you enjoyed the webinar. I really do. Please visit tradersway.com, open an account. We can work with each other every single day. Monday through Friday. The button is in the back office to join the webinars at 7:30 in the morning, New York time. Thank you to FX Street for hosting us for the 149th month. Next month is 150 months. Wow. How amazing is that? So again, thank you. Thank you for your time and your 3 hours today. I appreciate that. If you're watching a recording of this, maybe it's Saturday or Sunday, leave a comment, give it a like, give it a thumbs up, all of the above, out of respect to FX Street. It's important for FX Street to get those types of things because it helps rank their videos higher and stuff. So out of respect for FX Street, make sure you subscribe and like and comment, okay? And of course, visit Traders Way.